Our last topic in chapter 12. I know I've jumped around a little bit, but hopefully you can follow along based here. If you wanted to read more on the topic, I try to indicate which topic I'm lecturing on, but also know we're covering all topics in chapter 12, right? 12.1 through 12.5. I've just been jumping around, but we have covered them all, I promise you. All right. So contingent liabilities is our last topic. Now, maybe you have heard that term contingent before, right? Contingency plan, for example. It means our plan to take certain action if a specific event occurs. So with respect to liabilities, contingent liabilities represent liabilities. I should say potential liabilities if a specific event occurs. Okay, so it's if blank, right? That's the event. Then some sort of liability, right? So the most common examples of contingent liabilities, lawsuits, right? So the contingent event, the specific event is we lose the lawsuit, right? Then we must pay damages. Okay. And if we must pay, that's an obligation or a liability. But us having that liability is contingent upon the outcome of the lawsuit. Okay. So that is one of the more popular contingent liabilities. Another example of contingent liabilities, warranties, right? We must pay for repairs contingent on if product defaults or is defective, right? So us having to pay for repairs is contingent on the event that that product does break down or have some sort of defect. So that's a warranty. And the last one is debt guarantees. So that means that we are guaranteeing the debt of another individual. So kind of like if you're ever asked to co-sign a loan, right? It means that if that person defaults, we have to pay the loan. Okay, so we're liable to pay if, in that case, the other party defaults. We only have to pay, our liability is contingent on that other party defaulting. So those are examples of contingent liabilities, some of the more popular contingent liabilities. So then the question from the accounting standpoint is, how do we report these? How do we report contingent liabilities? Right? Think back to like our GAAP principles, right? We really believe in full disclosure. We believe in transparency, right? These are all qualities of financial statements, of financial information, good financial information. So we have this helpful little matrix that will help us determine what exactly it is we need to report depending on the situation. So the first thing we're going to look at is the likelihood of that event occurring. How likely is it that that individual defaults, that that product defaults, that we lose the lawsuit, right? So we need to know the likelihood of the event. They will give us three kind of key words to let us know. Either the event is probable to occur, right? It's probable that we will lose the lawsuit. Possible or remote are the three buzzwords they're going to give you, right? This has the highest likelihood, middle, lowest likelihood of occurring. Then we need to know, can we estimate the amount, right? It's going to be hard to record if we don't have an amount that can be estimated, amounts cannot be estimated. So those are the two scenarios. Okay, if we can estimate the amount, we know exactly how much we're being sued for, and it's likely we're going to lose the case, we must record the liability. Okay, when it says record the liability, that means we book some sort of loss from lawsuit, and then it's got to be a liability. So litigation settlement payable. Something like that, some sort of payable, right? If it's a high likelihood the event's going to happen, but we just cannot estimate the amount, then we must disclose that information in the company's notes to the financial statements, which accompany the financial statements at the end of the year. If the event is possible, whether or not we know the amount or not, same thing, we will disclose in the notes. If there is a very low chance of this event occurring, we need to take no action. Okay, no action is necessary, meaning we don't have to journalize it, and we don't even have to disclose it. Okay, so look for those buzzwords, probable, possible, remote, and whether or not the amount can be estimated, and use this table to help you determine what action you need to take. And just to show you this is what large companies do, here's a little excerpt from Barnes & Noble, one of their last annual reports. It tells us in the notes, the company records a liability when it believes it is both probable that the liability will be incurred and the amount of the loss can be estimated, right? So they're letting them know that's the only time that we are going to record the liability. Okay, and man, if you look at their notes, they have a lot of liabilities that they disclose because it may not be probable or it may not be estimable. Okay, let's look at an example. Here we have claims are us. They're the defendant in a lawsuit. It's possible, there's that keyword, possible that the lawsuit will be successful, meaning we will lose because we're the defendant, we're being sued. Damages are estimated. Oh, we can reasonably estimate it. But as soon as you see that possible, you know the only action we're going to have to take is disclose. Okay, go back to your table here. As soon as you hear that word possible, doesn't matter if we can estimate it or not estimate it, we're just going to be disclosing it. Okay. All right, good work. You're done with chapter 12.